Hi everybody, good morning, good afternoon, good evening, wherever you are. Welcome to our webinar Q1 2016 shipping rates. Thank you for joining. We have a good number of people on the line. We have close to 100 people and more people joining in. So we're happy to see those great numbers. We can go on to the next slide. My name is Catherine Barrios and I am today's host and facilitator. I'm joined by my colleague and CEO, Patrick Berglund, who is host and presenter. There's a few important items that I wanted to get through before we get started. The webinar is scheduled for 25 minutes with a 5-minute Q&A session reserved at the end. All attendees are muted, so if you would like to ask a question, I ask you to use the question area that you'll find in your webinar panel. We'll do our very best to answer the questions during the live webinar at the end of the presentation. If we don't get to your question, we will contact you individually with an answer. Another thing to note is that we are currently recording this webinar. We'll send everyone who's attended and also those who have registered the recording tomorrow. So please be on the lookout in your inbox, and we encourage you to share the presentation, the webinar with your colleagues. That is that on the housekeeping items. So if we move on then to the agenda. Today's webinar is split up into 4 sections. First we'll start with an overview of just our platform, quickly 1 slide on how we gather the information, our data, some of our key strengths. Then we'll move into the main highlights of Q1 and the shipping rates that we've seen for the past 3 months, and also give you a glimpse into the Q2 rates. At the same time, we will run a live demo of the Xeneta platform. Patrick will be switching between the PowerPoint and the live application demonstration, so bear with us in case there's any funny things happening there between the screens. And then we'll end with some closing remarks and reflections from our side. And then we will open up for questions and answers, and remember to put those into your question window. You can of course ask questions as you like throughout the webinar into the question pane, and we'll get to those towards the end. That is all. So now we can get started. Actually, I move it over to Patrick.
Perfect. Thank you, Catherine, for the introduction. So before we go and have a look at how Q1 has developed, I want to put some basic things in place, and that is mainly where we source our data from. And the data comes either from the shipper or the consignee, actually the one that would be in control of the supply chain owning the freight rate contracts. These shippers or consignee would either go long or short in terms of contracts in the market, and they would usually this would usually correspond with their annual volumes. And we see from our data a clear pattern that from around approximately 1,000 TEUs shipped on an annual basis, they tend to go with longer term contracts. But we also source data coming from the NVOCC and freight forwarding side. And this would be various data sets such as FAK, named account basket, or named account contracts. But whichever data we receive, we tag it so that the users and customers can segment our data the way they like to review it to cap the relevant market trends for them. Now, some of the key strengths of our platform and what makes us different is that we have a lot of data. The density of our database grows daily as companies upload more data into the platform on their accounts. And so far we've collected more than 12 million contracted freight rates. And with such a database available, we can provide accuracy and a healthy market spread to our users, empowering them with relevant intelligence based on a massive amount of objective data. What is also important to note is that our data is dynamic, meaning that Xeneta updates as soon as data is imported. And companies in our platform updates their data on a daily, weekly, monthly, quarterly, 6-month or even 12-month basis, depending on the duration of their contracts, whether they go short, mid, or long. This means that the data is fresh and relevant for the different users and can be viewed in real time and on demand. On the same note, we are a cloud-based software platform. We're not a shipper, a freight forwarder, or a carrier, so we're neither in partnership or related to any of the aforementioned. And through this, we are an independent and objective player in the industry. And our proposition is to provide ocean freight rate transparency by using technology and being innovative. And we believe in providing visibility into the freight procurement with data that delivers facts and help you do business better with actionable metrics. So with this being said, I'm going to take us to have a look at some highlights for the first quarter of this year. And we're going to begin off with short-term contracts. And we've chosen two main corridors for this webinar. The first one would be Far East Asia main ports going into North Europe main ports. And for the short-term data for a 40-foot container, comparing the last day of the quarter with the first day, there's a 78% drop in the market average. The lower end of the market has dropped with 68%. Now the second corridor that we've chosen is the Far East Asia main ports into North America Southwest Coast main ports, where we see equal declines, where the market average has dropped with 67%, comparing the first day of the quarter with the last day of the quarter for a 40-foot container. Lower end of the market has dropped even more significantly with a decline of 81%. If you look at the same two corridors for long-term contracts, especially the Far East Asia to North Europe main ports seems to have hit a bottom low. So the market average for a 40-footer long-term contracts from Q4 last year into Q1 this year has moved from $1,562 to $1,124, which is a 28% drop. But if you look at the lower end of the market for a 40-foot container long-term contracts, the drop is from $830 to $580, a 30% drop. The second corridor we've chosen has much less of a drop. So you will see that the Far East Asia main ports into North America Southwest Coast has dropped with 7.7% for the market average for a 40-footer and 5.3% for the lower end of the market. Now it's important to keep in mind that this particular corridor is currently in its tender season. So with the Far East Asia into North Europe corresponding with the calendar, the North American corridor is currently heavily tendered. Now, these are some highlights. What I want to do next is that I want to go to the platform itself and have a look at a few of these numbers that we just looked at. So I've selected here Far East main ports into North Europe main ports. We're looking currently at a 40-footer, and on the y-axis you have a US dollar value that represents the all-in cost going CY to CY, so container yard, and I've chosen the timeline to view the first quarter of this year. This is the market movements for short-term contracts. And if I move the mouse cursor inside the graph, you will see that the average going into this quarter was heavily impacted by the introduction of GRIs related to the Chinese New Year. So the market average for a 40-footer was at $2,062, and then towards the end of the quarter, the average was down to $464. If I then select the market low, you will see that the impact of the GRI was not as significant average, and the decline is of course then less, where it started off at $804 in the beginning of the quarter and it ended up at $255. If I use the slider at the bottom here to show you how these lately introduced GRIs has impacted the market, you will see that there's a bit of an uptake for the market, and that the GRIs are currently in place. If you look at this in a percentage view, it's the exact same time scope selected, only viewed in percentage, where you will see that the market average was down with 78%, as I mentioned in the highlights. Clicking on the market low, you will see that it's down with 68%. While if I introduce the GRIs in this view, you will see that even though the market has gone up, it's still down with 30.5% 75% for the market low and 59% for the market average today compared to the first day of January. Now, moving on to long-term contracts. This is Q4, long-term contracts, 40-foot container, still same corridor for Q4 compared to Q1. And you will see the significant decline that we reported in the highlights and how it's reflected when a lot of the contracts were expiring according to the calendar year and new ones was negotiated and in Q4 to begin validity starting beginning of Q1. And if I select the market low here, you will see the spread and the absolute values when I have the mouse cursor inside the chart. So today, no, sorry, apologies, but by the end of the first quarter, the lower end of the market for long-term contracts on this corridor was at $568 US. The average at 1,065. And you will see if I go into April, you will still see another slight decline. In Xeneta, you can also take a look into future contracted long-term contracts. So I will do a glimpse into the next 90 days. We see in this chart still selected 40-foot container, long-term contracts, same corridor. And you will see that there's some more declines before the market moves a little bit up. This indicates to us that we've reached more or less a rock bottom for this particular corridor on long-term contracts. Lower end as well, same flattening out before it has a slight increase again towards summer. Taking a look at the other corridor we've selected, Far East main ports, North America's southwest coast, 40-foot container and short-term contracts. You will see slightly different pattern, but again a significant decline in the short-term data, where the market average started off at $1,341 US before it has moved down by the end of the quarter to $437 US. Even more significant, you will see the lower end of the market by the end of the quarter ending up at $180 US, 188, while the starting point going into the quarter was more than $1,000 US for the lower end of the market. Again, in this example, taking into effect the impact of the recently introduced GRIs, you will see that the market trends a little bit upwards for April. This view in percentage would show you that by the end of the quarter, the market average was down with 67%, and the lower end of the market was down with 81%. The impact of the GRIs compared to the first day of the quarter has reduced the reduction, but still significant numbers compared to beginning of first quarter. Long-term contracts and future contracted long-term contracts for this same corridor looks like this. So we reported in the highlights some decrease from Q1 to Q2. Now you will see as the tender season for this corridor is currently processed, you will see a lot of new contracts being negotiated at a lower level for the next 90 days. If I also select the market low, you will have the absolute US dollar values for a 40-foot container, long-term contracts, Far East Asia main ports to North America southwest coast. So we're expecting to see these declines based on what is already contracted in the market. The last corridor we want to have a short look at is the reverse corridor of what we just looked at. So this would be North America southwest coast going into Far East Asia main ports, so export out of the US for long-term contracts, and you will see how much that corridor also has declined over the last 3 quarters, taking next quarter into account. So there's significant drops in all main corridors that we just looked at. And what we're starting to question ourselves is how sustainable this is, because if you look on a longer time period, and this is going back to Far East Main into North Europe Main, but I've selected the beginning of 2014 as the starting point, and I have also applied a trend line to this chart, and you will very easily and clearly see how the trend has moved over a bit more than 2 years. And this is of course also representative in the market low, and it's also representative for long-term contracts over the same 2-year horizon. This leads us to question how sustainable it can be and what we would expect out of 2016. So some of our closing remarks would be that both short and long-term rates have been on a steady continuous decline for a longer period of time, which also indicates that both smaller and larger volume players on the buying side have been getting really competitive prices over the last, let's say, few quarters. And back again to my point about whether this is a sustainable market, and we clearly mean that it's not. And we will expect to see rate increases during 2016, especially for the short-term market, as that's where they have the opportunity to adjust. I want to leave you with one more example of a use case from our platform. So I've chosen a specific customer account. I've sticked with the corridor that we have reviewed today. I've selected a 40-foot container, and I've chose here to look at our beta platform that you can also see some of the things that we're currently building. This is a long-term contract view. It shows you the market high, the market low, and the market average. In this view, we have the customer's NVOCC as a supplier, but we've chosen to see their prices relatively to the movements of the market. So what we're effectively looking at is periods of time where this particular shipper has lost money compared to the movements of the market for long-term contracts and gained money. And this shipper joined us last year with the intention of working together with their supplier, their NVOCC, to have prices that's consequently below the market average. And I think it's a perfect example of what you can do when you empower yourself with data. And this is very interesting both from a supplier and buyer perspective, because it also fosters a very healthy business and healthy and transparent business relationship between the buyer and the supplier. Okay, I believe we're reaching some of the time limit. It wasn't, we set half an hour for this webinar, but we're now opening for Q's and A's. And I see that there's a lot of questions that's been poured into the question pane here. Catherine, do you want to make any comment before I select a few of these questions?
No, we'll just take a few seconds to go through the questions. We have quite a lot of questions coming through, so you have a look at those. In the meantime, please do continue asking questions, even if we don't have time to answer those. We will get back to you over email. So let's see, Patrick.
Yes, so let's start with the question about the scope of the rates, gate in CY. So to us, and I'm going to pull up our web pages here, you can still see that, I assume. What we do is that we receive all kinds of data sets from the shipper side. They have different structures and everything in their Excel, in their tenders, and based mainly in Excel spreadsheets. Now what we make sure is to structure, cleanse, and validate the data so that it's apples against apples, meaning that we take everything that's relevant for a port view, so all surcharges included, to calculate an all-in US dollar fee. If there's any other currency included, there's daily currency converting in the platform to US dollars. That being said, we also deal with THC. The way we deal with THC in order to make this gate in, gate out, CY comparisons possible is that it depends on where you move cargo from and to. So basically what we have in our system are 4 different types of indexes. One that includes origin and destination THC cost, one that only holds destination THC, one with origin only, and one that has none. And we built up our database based on what's common market practice in our industry. So if you look at this table here, if you move cargo from Asia into Europe, the indexes you will be looking at will be excluded origin and destination THC. While if you go from Europe to North America, it will be origin and destination THC included. And this is what we make sure to align the data to. Okay. Yes, then we have another question. How do you define short-term contracts and long-term contracts? Where is the break line? Perfect question. So if I go back to the platform, what you will see here is that I've currently selected less than a month of validity. So any data that goes into our platform has a predefined valid from and a valid to date attached to it, which means that we immediately know the duration of the contract. So we can basically segment on any brackets that we'd like, but we've started with this one that says less than a month, which is defined as short term, and we've chosen more than 3 months as long term. And the reason to choose more than 3 months as long term is that we see that a lot of the shippers has annual contracts with floating bunker adjustments. So in order to capture those annual contracts, we've chosen 3 months, more than 3 months as long-term contracts. Now, next question. So the best time for starting a sea freight tender for Far East westbound sea freight is now to get best possible rates for the next 2/3 quarters. So not 100% sure about this question, but I assume it's about the timing of your tender. And if we're talking about Far East Asia into North Europe main ports, or even Far East Asia into North America, both of these corridors that we currently looked at definitely seems as a good point in time to negotiate longer term contracts. And I base this answer based on the fact that historically this is a very low level for both long and short-term contracts. And at some point, the values become so low that the importance for the shippers becomes somewhat reduced before the market then shifts up again, and it has a bigger impact. Okay, very good question. What do you mean by market low? So apologies for not clearing that one up straight from the bat. So the market low in Xeneta is a 2.5% tier of the market. It's a statistical calculation that's called the percent point function, which means that we do not show the absolute lowest values. If I were to draw an example, there will be rates below the market low here, but we do not disclose how much below, which means that this market low absolute value that we are publishing represents a 2.5% tier of the top performing companies when it comes to price. Yes, then equipment type. You are taking 40 feet as a benchmark. Why not 40 foot high cube? And as you've seen here live in the system, there's 3 types of containers available: 20, 40, and 40 foot high cube. So the users can very easily switch between these depending on what they're interested in. Okay, very interesting question, and we discussed this particular question before we connected with the webinar as well. That do you foresee shipping lines going belly up this year? And it wouldn't be a surprise, but if you look historically on this, there's very few liner shipping companies that has gone belly up because they've been how can I put this, saved by some banks and maybe even some governments. So we're being very cautious about stating that openly to the market, but what we do know is that the levels that we see now are not sustainable in the long run. So whether it's consolidation, bankruptcy, or yeah, I wouldn't dare giving a bet on that, but there's definitely it's got to be some changes in the market levels. Otherwise, there will have consequences. What is the software application you're using to draw straight lines? I think you're asking actually about what kind of WebEx tools we're using, and it's a mixture of two tools. It's not very relevant for this session, but it's JoinMe and Cisco's webinar tool. Then we have questions about whether we're averaging port rates and door rates. We do not deal with door rates, and the simple explanation is to that is that then you end up with trillions of combinations, and the opportunity to find overlapping data sets will be close to impossible. And the reason why we've chosen this particular part of the supply chain with the ocean freight is the fact that it's the one that we consider to be most volatile within a supply chain that holds liner shipping within it. So it's volatile, and it's also, from our point of view, the most opaque one. Then there's a question whether we can strip out bunkers and assess the base core rate movements. So in theory we can. So we receive the data, raw data from each and every shipper. So if they have specified bunker clauses in their contract, that could be extracted and published some information on. But one of the key feedbacks we've received from our users is how simple and intuitive and user-friendly our software is. So we will continue to have a simplified approach to the front end of our software. But that being said, if there's any special requests to anything our data can solve, we do deliver that kind of services in our advisor product that's published on our web pages.
Patrick, we have time for 2 more questions, and then the rest of the questions we will answer over email. You want to take out 2 questions?
We actually got one question here as well. We have several questions that we're not nearly going to be possible to go through all, but there's one that I'm very passionate about, and that is how this can foster a healthy relationship with suppliers if the tool will drive cost below market average over time, which cannot be good for suppliers, right? So one of the key things I in particular have learned over the last, let's say, 3 years, speaking to where the company has spoken to thousands of shippers, is the fact that a shipper is not necessarily looking for the absolute cheapest rate in the market. They're looking for a competitive rate, right? So I think that there's some basic business fundamentals here where you can build and foster a very transparent relationship with your customer, looking at this from a supplier side of view, where you can ensure them that they have a fairly competitive price compared to the market, while you're still not trying to, let's say, rip them off, right? So basically, what I'm saying is that you can act transparently with your customers, and I'm very confident that the outcome of that is not a rate chase to the lowest rate possible. And in all fairness, we've been working with both the supplier side and the buyer side, and everything we get reported back to us is that there's less focus on price when they use these kind of tools between them, because for a shipper point of view, this is not their core business, but they want to make sure that they have a decent competitive price and are not paying twice of the average. And we recently launched an interesting blog post about this as well, where I encourage you to read more about this topic as well in terms of what is a good price. Okay, one more question, Kathy? There's a question here about which corridors. Perfect. So there's a question about which corridors we offer coverage on, and we offer coverage on any port peers that the user base uploads data on and as soon as the data is dense enough, then the system automatically opens up those corridors. And as in the intro, I mentioned that we had more than 60,000 port pairs covered in our system. And we also have a geo-hierarchy in place in our system that gives us even stronger coverage, which means that if there's a scarce full amount of data on, let's say, 5 closely located port pairs, and you're then able in our system to pull them together in order to take all the data and then go from region to region. And if you use one layer up in our geo-hierarchy, region to region, we can offer coverage on more than 160,000 port pairs. So this really depends on what the users have submitted in terms of data into the platform and how you leverage the system with this geo-hierarchy. Yes.
Okay.
The remaining, there's a lot of questions here, and we will need to follow up individually with each and every one to get through this. But yeah, thanks a lot for joining today, Catherine. I'll leave it to you now.
Good. Thank you, Patrick. Thanks a lot. I hope the webinar and the information that we presented was interesting and useful for everyone that attended and stuck with us. Just as closing remarks, you will receive a 4-question survey immediately following the webinar. It's very short. We kindly ask you to take just a couple of minutes of your time to give us feedback. We will continue this webinar series that we started back in February. This is our second one now. Monthly and periodically, giving a lot of stats and information that we're currently seeing in the Xeneta platform on a variety of topics. So therefore, we really encourage you to give feedback on any topics that you would like to see a webinar on, or anything that you would like for us to cover, the same as blog posts. And also encourage you to follow our Xeneta blog. Sign up for notifications where you'll get instant notification when we post information. To keep abreast of what's moving and happening here on the Xeneta side. Thanks a lot for joining us today. We wish you a great rest of the day, a great evening, and we see you soon. Thanks a lot.